A door that had been closed for years has just opened. The SEC and the CFTC have announced that regulated exchanges can list certain crypto spot assets even with leverage and margin. This is not a new law, but it is a clear signal. So what changes? If they file rules and get the green light, it would mean greater liquidity, tighter spreads, and real oversight thanks to the same monitoring systems traditional markets already use. It sounds like the perfect news, but watch the calendar. On October 21st, the Federal Reserve is gathering the industry to talk about stablecoins and tokenization, right after the Genius Act, which sets reserve standards without mandatory reporting. Translation: less gray area and more banking-style rules. Meanwhile, Europe is enforcing MiCA, stressing one-to-one redemptions and zero hidden fees. And China is exploring a yuan-based stablecoin, regulatory competition in full 4K. And in this video, we'll also dive deep into the Ethereum blockchain. And believe me when I say, after this in-depth analysis, we couldn't be more bullish. First, regulatory updates in the United States. The SEC and the CFTC just clarified that under current law, regulated exchanges, whether national securities exchanges, designated contract markets, or certain authorized foreign exchanges, are not prohibited from listing specific crypto spot products, including those with leverage and margin functions. This is a staff interpretation, not a law change, but it opens a formal path for large traditional markets to explore these listings with direct oversight. So what could change for the markets? If these platforms file and obtain approval for their rules and products, competition with crypto exchanges could increase, improving overall market quality by bringing more liquidity, tighter spreads, and stronger safeguards against abuses, all thanks to their monitoring systems and public reporting. Regulators also outline how custody and clearing should be managed to provide protections equivalent to other financial markets. It's a coordinated signal of regulatory openness, though not every asset qualifies. The focus is on specific spot products that fit within the frameworks of commodities and securities. This move follows recommendations from the President's Working Group, which called for clarity to keep blockchain innovation in the United States. In the short term, progress will depend on formal filings and how they define custody, data, and oversight. And if we've been talking about the SEC and CFTC, now it's the turn of the U.S. Federal Reserve, because this October 21st, they will host a conference on innovation focused on stablecoins and tokenization. Governor Christopher Waller frames it as a way to improve payment safety and efficiency, while also serving as a channel to hear from the industry. For markets, it signals that the central bank wants to influence how these technologies integrate into the regulated system. This timeline comes after the passage of the Genius Act in July, the first federal framework for payment stablecoins, defining who can issue, how reserves are held, and what disclosures are required. The Treasury and the Fed must now develop secondary regulation. That means less gray area and more requirements comparable to banking standards. On one hand, it paves the way for institutional adoption. On the other hand, it raises the compliance bar. What's the potential short-term impact? Priorities right now are settlement tests using stablecoins for retail and interbank payments, tokenized asset pilots like bonds, and new rules on oversight and cybersecurity for operators. If this work ends up in actual regulations, we could see more competition between banks, payment networks, and crypto issuers for faster and cheaper transfers with stronger transparency on reserves and audits. The global context reinforces the idea of regulatory competition around stablecoins. In Europe, Christine Lagarde has stressed that MiCA must close loopholes when the same stablecoin is issued both inside and outside the European Union. She calls for strong equivalency regimes and highlights two golden rules. Redemptions must always be one-to-one, €1 per unit, and there must be no redemption fees. The logic is simple. In a mass withdrawal, holders will seek redemption where they are best protected, most likely within the EU. Without agreements linking protections across jurisdictions, reserves in countries with weaker rules might not be enough. In the United States, the Genius Act, passed in July, requires 100% backing with cash or treasury bills, along with monthly reserve disclosures. This gives dollar issuers a regulated path that could speed up adoption in commerce and business payments. For Europe, this isn't neutral. Piero Cipollone from the European Central Bank warns that the America's pro-stablecoin agenda could shift deposits away from euros and reinforce the dollar's role in cross-border payments. And what does Piero think? Well, that's precisely what Donald Trump is aiming for with this legislation, among other benefits, strengthening the role of pro-stablecoins. And of course, Europe has noticed the danger and is now rushing to develop its own CBDC. Meanwhile, China is exploring a yuan-linked stablecoin, as reported by Reuters in August. The goal would be to push the internationalization of the renminbi in a market dominated by dollar-backed stablecoins. It seems China has just realized that Trump's U.S. strategy of promoting stablecoins poses a real threat, as Europe also warns. That's why China, in addition into developing its own CBDC, is now stepping into the stablecoin race. They had plenty of time, but at least they know how to react, unlike Europe, which is still catching up. In June, the yuan represented just 2.88% of global payments, compared to the dollar's 47%. According to SWIFT, a renminbi stablecoin with potential pilots in Hong Kong and Shanghai could try to close that gap if regulation allows it. So what does all this mean for markets? In the short term, it means more clarity and more competition between global blocks. The US is accelerating the tokenized dollar in payments. The European Union is tightening entry gates to protect stability and monetary sovereignty. And China is testing tools to project its currency. And now let's move on to analyze these blockchain charts, which, let me warn you, are a real open book. But before that,
welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
Now let's analyze something very interesting. We're going to look at the Ethereum blockchain, and let's start with the main course, those wallets holding between 1,000 and 100,000 ETH, the massive whales we always like to follow. Notice how from early August to early September, they kept accumulating, even during moments when the crypto market was facing slight bearish corrections. This should really grab your attention because we can assume many of these whales are actually large institutions, and what we're seeing is a strong bet on Ethereum. Even when Ethereum was stuck in a range, these whales kept buying because clearly their target is much higher. And right now, this accumulation trend by mega whales is still very active. But here's where it gets interesting. If we analyze Ethereum ETF flows, you might wonder, how can whales be accumulating if we've seen 3 straight days of outflows from ETFs? Well, here's the key point. Those outflows only represent 1.3% of total assets under management in Ethereum ETFs. In other words, the number in red may sound alarming and create big headlines, but it doesn't mean institutions are exiting Ethereum. Remember what I've said before, ETFs shouldn't be seen as instruments used only by funds and institutions. You could go buy an Ethereum ETF yourself today, and in that case, you'd be more of a fish than a whale. Of course, if a whale is listening to me right now, you can also buy an ETF. But the point is, this supposedly catastrophic figure tells us nothing. And if we look deeper at the ratio of long versus short traders in 2 of the main exchanges, OKX and Binance, we see something very telling from August 19th up until today. That ratio is clearly bullish. The market right now is heavily optimistic. It has been since early August, and nothing has changed in the last few days, neither on OKX nor on Binance. Traders are still going long. And here someone can say, hey, aren't you a contrarian? Shouldn't we bet against that optimism and go short? And my answer is, there are contexts and contexts. Look at those giant whales still accumulating long positions. That's why we can assume that the optimism we see in these exchanges is not just coming from retail traders that we should fade. Because honestly, what we're seeing on the blockchain, and this is a fact, not debatable, is that whales are buying, or better said, whales are still buying Ethereum. And now look at the demand for put options on Ethereum. Here we're focusing on the premium. When the premium of put options on Ethereum goes up, the expectation is that investors believe Ethereum will fall, since they want to capture that premium by betting on a price drop. But as you can see, the premium on Ethereum puts is practically on the floor. Even now, when the daily chart for Ethereum looks extremely bullish, the options market is not selling Ethereum either. And let's remind ourselves, once again, what are the whales doing? We can't forget that. At the same time, we're at extremely high levels in the queue of investors eager to stake Ethereum. So when does an investor want to stake? The answer is simple. Only if they expect a positive revaluation of the underlying asset. If I think Ethereum is going to rise, I'll lock it up in staking to earn rewards while helping the stability and functioning of the network. And as you can see, investors are lining up like crazy to stake Ethereum. And as has already become a theme in this video, we can't ignore the sentiment of whales right now. In fact, this long queue to stake Ethereum combined with whales going long, with investors holding many more long positions than short, and with put premiums at rock bottom, leads to one clear consequence. Ethereum reserves on exchanges are collapsing. One of the main reasons is the recent strong wave of investment we've seen over the last months into Ethereum ETFs. This alone reduces supply on exchanges, since ETF managers must hold their own reserves of the underlying asset and remove them from the order book. Another reason is the increase of investors eager to stake Ethereum, which also takes coins off the exchanges. And on top of that, we have the rise of companies holding Ethereum in
in their treasuries. If these companies buy Ethereum and withdraw it from the order books to keep in reserve, plus ETFs accumulating, plus staking, all of this drains supply on exchanges. And what does this drop in supply mean? The main and most important consequence is lower immediate selling pressure combined with higher price sensitivity. The logic is clear. If there's less supply and less selling pressure, whenever institutions come in aggressively to buy, the counterparties they find on the downside in terms of liquidity are much smaller. Therefore, we could see strong bullish aggression if institutions continued to buy. And, well, as we can see, they are indeed buying. Now, let's analyze the whale and net position change for addresses holding between 1 and 10,000 Ethereum. Basically, what we're looking at here is the net 30-day change in balances for this group. And what do we see? The 30-day net change is shown in this purple histogram. When the histogram is above 0, we understand these addresses are in an accumulation phase. And when it's below 0, they're in a distribution phase. Notice how the last time they were accumulating, look at Ethereum's price in black. During that area, they were really preparing to launch a bullish trend. And what do we find now? Once again, these whale addresses are positioned with long exposure to the market, specifically in Ethereum. Different way of analyzing, but the message is the same. Whale sentiment today is bullish on Ethereum. Now, in this chart, we're looking at the percentage change of open interest over the past 24 hours. What does this tell us? When open interest is positive, shown in the green histogram, it means retail traders' exposure to the market is increasing. And the change is fast because we're comparing one day to the next. It's very sensitive, perfect to measure retail sentiment. On the other hand, when open interest decreases day to day, we understand that retail traders have less appetite to invest. And here's the surprise. Analyzing retail behavior through open interest for the first time, we see that when open interest is low, dropping sharply from one day to the next, retail assumes the probability of price going up is lower. But look at the black line. Price actually goes up when open interest is very low because retail thinks it's not worth buying. Classic mistake. Once again, retail investors tend to be wrong. And what stands out right now? Open interest is declining, less and less interesting for retail. We're seeing that small investors are losing appetite or simply not willing to invest in Ethereum. That itself tells us something revealing. Does it mean we should buy today or tomorrow? Not necessarily. What it tells us is that retail investors are clearly putting less money into Ethereum. And as good contrarians, that should grab your attention. Now, let's look at something different. Not the total holdings of big wallets, but the total number of wallets with 10,000 to 100,000 Ethereum. The blue line shows the growth of those wallets. The creation of new wallets here can signal that investors, whales, or institutions are stepping in, always if the trend is positive. And the green background line is Ethereum's price. So what's happening in general? These 10,000 to 100,000 Ethereum wallets are increasing, but what's striking is that during this corrective phase in Ethereum's price, the number of wallets held by whales and institutions is rising while the price is falling. Question, are these institutions opening wallets for no reason, or maybe because they're preparing to buy in a context where retail has no interest? In future videos, we'll do advanced technical analysis of Ethereum's price to forecast where it could go after analyzing all this blockchain data, because all of this information is incredibly useful, but we now need to cross it with Ethereum's chart to find the best investment opportunities as well as to identify the levels we don't want to see broken. Now tell me, what do you think about Ethereum, about stablecoins, CBDCs, and the future of Bitcoin and crypto prices? Leave me your thoughts in the comments, and if you enjoyed this advanced technical analysis, give the video a like, subscribe to the channel, and click the bell so YouTube notifies you of future uploads. Best of luck with your investments and see you next time.